A very warm welcome to one and all. I'll just give a brief introduction about our association, RAI. RAI is the unified voice of Indian retailers working with all the stakeholders for creating the right environment for the growth of the modern retail industry in India. It's the premier body of retailers having around 14,000 member establishments, including large and the small retailers in the country. We represent around 500,000 retail stores and provide this direct and indirect employment to 50 million Indians. So without any further delay, let's understand the impact of this budget 2023, the recent GST amendments, and the judgments on the retail industry. We have amongst us Mr. Sanket Desai and Mr. Rahul Kakkad, who are the partners at Ernst Young. We also have Mr. Parekh, who's the National Retail and Consumer Sector Leader, Tax and Regulatory Regime at Ernst Young. We've also received a few questions from the participants, which will be answered in due course. Over to you, sir.
Thank you, Palak. So first, let us look at the background in which the budget has been prepared. As all of you know, there are global headwinds, geopolitical uncertainties like war, tightening global monetary conditions, FedEx interest rate increases. There has been high inflation across the world and still lingering effects of pandemic. And in fact, the global growth has been kind of reduced from 6% to 2.7% in 2023. Amongst this situation, India remains a bright spot, relatively lower interest rate increase. The rupee has also outperformed several other global currencies. Relatively, the consumer inflation has been on the lower side. There has been good investment expenditure and private consumption and higher tax buoyancy. In fact, the government's focus on long-term levers for economic growth continues, like the PLI scheme success and the investment in infrastructure, and especially the digitization and payment system increase actually helps credit flow to MSMEs. Even energy security and decarbonization efforts have been very tactical and strategic, like buying oil from Russia, etc. Even G20 leadership to India will ensure that there is global stability on our relationships and multilateral coordination. As far as the economic survey results are there, or the forecast is there, the GDP growth is likely to be around 6.5% in 24. The global growth is likely to be lower, but India will stand out. On fiscal management, the tax revenue growth in this year from April to December 23, 6 months from now, is likely to be 12.5%. The GST collections have been above by 20%. So overall, good fiscal management, and even capex push has been good. The external sector like net export has been a bit of a concern. There is a negative contribution of net exports to real growth. When it comes to monetary management, the credit growth to MSME sector has been remarkably high. It is 30% higher during Jan to November period. This is a very good sign for MSME growth. The PLI success is also a good sign. So in light of this, the budget has made some announcements, and some of them are quite critical and relevant for the retail industry. I think the entire infrastructure push, capital expenditure push by 33%, and the PM Awas Yojana, which is expenditure estimated around 79,000 crore, which is 66% above the earlier year. This is likely to ensure there is good flow of money in the semi-urban and rural areas, and I think it will increase the disposable income, employment, and overall traction in the economy. Even the youth empowerment schemes around Skill India is likely to help create job training, industry partnership, and alignment of courses with the needs of the industry. I think overall, the infrastructure investment, gift city related developments, ease of doing business, where they are talking about common business identifier, KYC process, and promotion of green energy. All of that, I think, is likely to give a good boost to employment generation and a good boost to increase in the disposable income in the economy and to the consumer and retail sector overall. There are some concerns which Rahul Kakkad will talk about on the startup related funding, and there are a lot of GST related amendments and also custom duty related amendments which Sanket Desai is going to take us in detail, which will again give a push for Make in India. So I think overall we are looking at more positives than expectations not met. With this background, I will request Sanket, which all of us are eagerly waiting to hear around the GST related developments. Sanket, over to you.
Thank you very much, Paresh, for sharing your insights on the budget impact and the vision of the government of India for India's growth story. So before we proceed, I just wanted to make sure that the audience is able to see the screen. I have shared the screen. Palak, if you can just confirm that before we proceed. Are you able to see the screen that I'm sharing right now?
Yeah, it's visible.
Perfect. Okay. Okay. So first we would want to get into the direct tax proposals and the impact of the budget from a direct tax perspective. So we have divided our entire session into broadly three parts. The first part is the direct tax proposals, which my colleague partner Rahul Kakkad will take all of you through that, and he'll share some interesting insights on how these amendments and proposals translate into the vision of the government of India. Second is the indirect tax proposals, which is essentially GST as well as customs. And the third part is we would also like to share with you certain recent amendments with respect to GST, some interesting judgments which have an impact on the overall MSME sector as well as large companies and small companies alike. And what should we be doing in the next 12 to 18 months to be ready for investigations, audit, assessments, tax positions, so on and so forth. So that's the broad structure of our today's session. I now hand it over to Rahul to take you through the direct tax proposals.
Thanks, Sanket, and good morning, everyone. So as Paresh mentioned, I think a lot of reforms in terms of capital investments in infrastructure. Also, one of the critical changes which was announced was, for individual taxation was the proposal for the new tax regime. So the FM has announced a new slab rates up to 3 lakhs, no tax, 3 to 6, 5%, 6 to 9, 10%, 9 to 12, 15%, 12 to 15, 20%, and above 15 lakhs, 30%. Also, what she's announced is that the surcharge, the peak surcharge rate for people earning income more than 5 crores has been reduced from 37% to 25%. So that brings about a savings of approximately 3.7 odd percent on an absolute basis. Also, if one opts for the new tax regime, the standard deduction, which was not available earlier, has also been reintroduced. There are a couple of things that one needs to be, wait and see is when the new tax regime was introduced a couple of years as well. There was an option available to opt for the new tax regime for all taxpayers. I think where the current wording is, I think the default is likely to be the new tax regime, and if one needs to continue for the old tax regime, it needs to opt for the same. So I think that's one change. Also, if you have to see, we've run a ballpark workings. If an individual is having exemptions more than 4.5 lakhs kind of a number, and having income more than 15 lakhs, the old tax regime still looks beneficial for an individual. However, request if you could, just validate before opting for the new one or continuing to the old one. Moving on, Sanket. There are certain exemptions which were available on capital gains earned by an individual on a sale of a property or any long-term capital asset being shares, etc. When an investment was made in a residential house. there was no threshold limit on the amount of investment and the deduction which would be available. There are a lot of startups, hired individuals who used to sell shares in companies and also avail these benefits. In order to curb the benefit and restrict the amount of investments and the benefit for HNIs and ultra HNIs, I think they've brought in a threshold limit of 10 crores. What it says now, the maximum deduction of capital gains that can be claimed under 54 or 54F would be restricted to 10 crores. Sanket, move on. They have brought in a TDS of 10% on listed debentures as well. Currently, there was no interest, TDS on interest, which was paid out by listed entities on debentures. The government realized there was underreporting or misreporting or no reporting of interest income by the recipients. And accordingly, to bring the same under the tax net, they have introduced a TDS on 10% on interest payments as well. I think over the period, one would have realized that the government is trying to ensure that all possible transactions are now under the gamut or under the net of TDS or TCS with 194Q also, which was introduced last year as well. So I think this is another move to ensure that all transactions are getting covered under TDS. TDS on payments on accumulated PF balances on employees who are not having permanent account numbers. For this is typically for blue collar employees who don't have PANs but have a PF account and there was a withdrawal within 5 years. Currently, the TDS on such withdrawals was up to 30%. At the maximum marginal rate, government has reduced the said TDS to 20% at the time of withdrawals. Enhancement of leave encashment exemption limits. This is interesting because we just found this as an announcement in the FM speech. We didn't find this amendment either in the memorandum or the bill. But what it talks about is that any leave encashment at retirement, there was a limit of 3 lakhs. Now it has been proposed to be increased to 25 lakh rupees. Hopefully, when the bill has been passed in the parliament, we should see this being enacted and brought into the bill itself. There were certain anti-abuse provisions for gifts, which currently covered residents and non-residents. However, a category of RNOR was not covered, so that is also being introduced. So now gifts more than 50,000 to an RNOR is also is made taxable. This is an interesting one, prevention of double deduction on interest on borrowed capital in relation to house property. So currently there are two provisions under which one could claim interest paid on housing loans. One was under section 24, which allowed, when you compute your loss from income from house property, that's one of the sections which predominantly people could claim the interest on. However, there is another section 48, which provided that at the time of when you sell an capital asset, your cost of asset or cost of acquisition of asset also include any cost of improvement, which at times people will also adding up the interest that they would have paid on housing loans. So the government has decided that to avoid any double deduction, any interest which is being claimed under section 24 will now not be allowed to be deducted or calculated at the time of computing section 48. This is ensured that one cannot claim the interest under two sections. Taxability of proceeds from high value insurance policies. As you would have seen over the last couple of years, the government has looked to cap the investments in insurance policies. ULIP was brought in a couple of years back with a threshold limit of 2.5 lakhs. Other life insurance policies were not covered. So this was used as an avenue by many individuals to make investments. And what would entail is that any bonus or any redemption of, at maturity was not taxable in the hands of the recipient. What the change brings in is that if for new life insurance policies where the policy exceeds rupees 5 lakhs after 1st April 23 on a standalone basis, or for all new policies, the aggregate premium exceeds 5 lakhs, then on such policies, on redemption, on maturity, the income that one would earn would be taxable as income from other sources. Ideally, this probably is a change, and government is probably wanting people to invest in other securities or fixed deposits like FDs, etc., which give a similar return, but they are taxable. So to ensure that the life insurance policy schemes investments are at par with other investment opportunities which are available in the market, they've brought in this move to ensure that both life insurance policies and other fixed deposit schemes, etc., are at par with getting taxability on maturity. Coming to the next theme of widening of tax base, there is a section 55 which looked at defining cost of improvement of cost of acquisition. However, there were certain intangibles for which no consideration would have been paid at the time of acquisition, such as customer database and so on and so forth. If it was self-generated, or what a particular consideration was not identifiable at the time of purchase. There is a dichotomy in the law itself, and people were wanting to take a view that at the time of selling such assets, the cost of acquisition was not defined as nil in the current provisions, because it defined only a set of particular intangibles such as goodwill, etc. So there were certain Supreme Court rulings, etc. Relying on those rulings, assessees were taking a view that since the cost mechanism itself fails, there should not be any capital gains on sale of such assets. To ensure that an overruling such Supreme Court rulings, the government has said for all intangibles for which no consideration has been paid would now be regarded as nil. So they have broadened the definition of intangibles. So any planning opportunity around this, will not be available now. Any sale consideration will be fully taxed as long-term capital gains. Penalty prosecution on non-deposit of TDS. When 194R was introduced last year, a specific linkage to 271C or 276B was not introduced. So now they've extended the TDS provisions to attract on for both penalty and prosecution for deductions made under 194R, which is the TDS on benefits and perquisites, as well as 194S, which is TDS on transfer of virtual digital assets, as well as section 194BA, which is winnings from gamings and online games. So this is effective 1st April 23. There is a relief which is brought in for certain specified persons. As per the current law, a higher rate of TDS or TCS is applicable for non-filers of income tax return. However, specified persons was not defined. They have now included to say that a specified person will include a non-resident who doesn't have a permanent establishment in India, or there could be certain persons who are not required to furnish the return of income. Such set of people would be exempt. And further clarity of other categories of specified person would be brought in, and as notified by the central government. So this is a welcome move for certain non-residents and other categories of people who are exempted for filing returns. For them, the higher rate of TDS or TCS may not apply. Taxability of market-linked debentures, MLDs, were considered as plain vanilla debt securities and exchange traded derivatives. The government has said earlier that it was taxed as long-term capital gains at 10% without indexation. However, they've said that irrespective of the holding period now, MLDs would be taxed as short-term capital gains, and no deduction in respect of securities transaction tax would be allowed. Expanding the scope of gift tax on issue of shares, and this is where probably Paresh also spoke in this. This is a very interesting change. If one has to look at the genesis of why 5627B was introduced, it was introduced for a particular section intent to curb routing of black money, etc., and particular sectors. and it was applicable only to resident individuals. So when an Indian company issues shares to residents, over and above the fair market value, the excess consideration was taxed in the hands of the company. So example, if my fair market value of a share is say rupees 10, and if I issue shares at rupees 100, the 90 was taxable as a gift tax in the hands of the Indian company. This section was not applicable in a scenario where the shares were issued to a non-resident. However, in this budget, it has been decided that the section will also be applicable to non-resident investors as well. Interestingly, for non-resident investors, the exchange control or FEMA talks about a floor price. So, what it talks about is that if the FMV is 10, one can get more than 10 and not below 10. So now one would have to see the interplay between tax, transfer pricing, and exchange control, especially when Indian companies, startups, etc., would want to raise funds or capital from non-resident investors. This could lead to a lot of ambiguity and a lot of litigation, harassment for the taxpayer. In order to encourage investments, reliefs were brought in for startups. Section 79, which spoke about a startup who's eligible to carry forward and set off losses, there was a restriction of 7 years from its date of incorporation. Typically, a loss has been lapsed, if there is a change in shareholding more than 51%. Section 79 talks about it. With a lot of startups, etc., with fundraise that they do and the capital dilution which happens with the founders, in order to protect the losses, given that in the initial stage, there will be significant tax losses for the startups. There was a 7-year window which was available to them. That has been relaxed further and extended to a period of 10 years. So that now the losses would be available for a period of 10 years from the date of incorporation. Also, there are certain tax holidays which are available for startups who were incorporated prior to 31st March 2023. The government has extended the sunset clause to say that any startup that may be incorporated on or before 31st March 24 will also now be eligible for tax holidays, subject to the approvals from DPIT, etc. Certain measures, Section 28(4), which currently covered only non-cash benefits or perquisites. There were certain Supreme Court rulings as well as circulars, which spoke about the intent of the legislature was to include also cash benefits or perquisites by the time of introducing 28(4). There are court rulings, however, said that cash perquisites or benefits are outside within the purview of Section 28(4), just to avoid and remove an anomaly and the ambiguity around provisions of 28(4). It is amended now to cover within its ambit the cash perquisites as well. And one would also appreciate that, when 194R was introduced last year, it was linked to the definition under 28(4). So, even consequently, Section 194R changes will also be applicable on cash perquisites as well. They had already brought in this in the circular, which was brought in the month of July last year as well. So it's more of a clarification which the government has brought in. This is an interesting change, and to promote payments to micro, small, and medium enterprises. Currently the MSME Act talks about that payments made to MSMEs would need to be made within 15 days. If the agreement is silent, or if there's a written agreement, it cannot exceed 45 days. There are a lot of hue and cry on payments which should typically be made. There are a lot of delays, etc., by SSEs when it comes to payments to MSMEs. To ensure that the MSMEs have a timely payment, they've amended the Section 43B to ensure that now payments will only be allowed to the MSMEs in the year in which the payment has been made. Also to note, while the heading, when the amendment brought in, it said payment made to MSMEs. However, when you read the fine print, they've only brought in to say the payments made to micro and small would be allowed in the year in which the payment has been made. They've excluded medium enterprises as of now. So one would have to ensure that when we get details of MSMEs on our record, when we onboard them, we'll have to further bifurcate between micro, small, and medium, and then comply with 43B rules, which is probably will form part of one's tax audit report as well, and then allow and disallow the payments as well. Facilitating the TDS credit from the income tax portal, historically this has been an issue. Typically, if an assessee reports 100 as his income and the corresponding TDS of say 10 in one fiscal year, at times there have been discrepancies because the person who would have deducted taxes may have reported the TDS in the subsequent financial year. This led to probably a lot of disallowances, mismatch of TDS credits at the time of assessment or giving credit by the assessing officer. They would then lead to quite a few rectifications or disallowances in one year and allowance in the subsequent year. So to remove all those hardships for taxpayer, the government has brought in that in such scenarios, the taxpayer can now file a rectification within 2 years from the end of the year in which the TDS has been reported into its 26AS by the payer. So, say for example, if a company has filed a tax return for FY21, March 21, however, the TDS has been reflected in the financial year 22-23, it can file within end of 2 years. So from 23 up to 25, a rectification application with the assessing officer to give credit of the TDS in the original year in which the income was reported. So this can happen during the assessment, after the assessment, but within a period of 4 years from which the rectification order was filed. And interest under Section 244 will only be allowed after the date on which the rectification application has been filed. Time limit for completion of assessment. The government has tinkered over the period on the completion of timelines from earlier 18 months to 12 months to 9 months. They've realized that this 9 months was cutting too short, and they were not able to complete the assessments in a timely manner or in a manner in which they would want to. Proper investigation was not happening. So they have increased the timelines now from again 9 months to 12 months period going forward. Same was the case for reassessments under Section 148. A return was technically required to be filed within a period of 1 month or as prescribed by the assessing officer. They have relaxed the timelines to 3 months or an extended period as permitted by the assessing officer. So this gives some additional leeway to the assessees, at the time of reassessment to understand, what is the reason, etc., and file their return and responses with the tax officer. They've reduced the timelines to furnish the TP documentation. As per Section 92D, TP documentation was to be filed with the TPO within 30 days of issue of notice or as an extended period as permitted by the AO/TPO. Again, to ensure that the TP officer has adequate time to go through the facts, documents, and come out with a fair assessment, they have reduced the initial 30-day period to 10 days to ensure that the assessees submit the documents well in time and complete and is given to the TPO. So one would have to ensure that all TP documentation, etc., are completed well within the time. So once a notice has been received from the tax officer, we can submit the requisite documents well within the time to avoid any penal measures for non-filing within the prescribed due dates. And lastly, given that there was a lot of pendency at the commissioner level of a lot of appeals which are being pending, they've now also, to help to clear the huge bottleneck of such pending appeals, they have now said Joint Commissioner of Appeals, JCIT, will also have powers similar to Commissioner of Appeals to dispose of certain matters involving small tax demand disputes. Certain orders which are appealable before the JCIT are 143(1), 143(3), so on and so forth. However, one would have to see that appeals cannot be filed before where they are being identified or being passed either by the deputy commissioner or after the approval of the deputy commissioner. So detailed guidelines for this will be awaited. However, given that we are in a faceless regime of assessment, when an order has been passed by the faceless authorities, we don't get to know the designation of the officer who has passed the order, nor if there is an approval which has been sought internally. That's also not available to the assessee in public domain as such. So this is one issue which may arise, that which orders are appealable before the joint commissioner as well. Hopefully, the department should clarify this in the near future to ensure that assessees don't have problems before approaching the JCIT, and the appeal is not considered invalid if the order was passed by deputy commissioner or after his approval. So we'll have to wait and watch. Hopefully some clarification should come in this regards. I think that's it from my end on the direct tax changes. I'll hand it over now to my colleague Sanket, who will take you all through the indirect tax proposals and the recent updates on the GST front.
Thank you very much, Rahul, for very crisply summarizing the direct tax proposals and the impact on the overall industry and also the members of RAI. I will now quickly take everybody through the indirect tax proposals. Yeah. So basically, when it comes to indirect taxes, the first point to note is that, as you would be already aware, the GST rate related changes for various products and services, they are now not announced as a part of the budget exercise, because we have a concept of GST council meetings, and these GST council meetings are essentially the council meetings of various state finance ministers who meet once in 3 months or once in 4 months, and they decide the frequency. The next one is happening on 18th of February, wherein they decide on the GST rate changes. But nevertheless, there are many other changes which have been announced in the budget, which are in the act, which we should be aware about. And I will try to summarize those proposals for all of you, which are absolutely relevant for us and impact us on a day-to-day basis. Yeah, just one sec. Yeah, so basically what I'm trying to say here is that the GST law changes. The first important change that has happened here is with respect to composition dealers who supply through e-commerce operators. So there is a concept of e-commerce operators wherein there are many small and medium scale entities or even large companies who sell through e-commerce platforms, and this part of the distribution channel is rapidly growing as compared to the conventional general trade or modern trade. And in the e-commerce platform, we have to, if you are a company, you have to basically raise an invoice, and the e-commerce platform entity will collect money from the customer, and then they will remit to the company. And they also do a TCS, or a tax collection at source, for which we get an input tax credit. So that's the mechanism. Now, till now, they had kept composition dealers, meaning dealers whose turnover is less than 1.5 crores, out of this, and they had said that they may not be permitted because composition dealers are small ones who are whose turnover is less than 1.5 crore and who pay a very concessional tax. But now they have said that even composition dealers will be allowed. So again, a move towards promoting small and medium sector, because the government has realized that e-commerce platform is there to stay, and it will grow further as we move ahead. But at the same time, what they have said is that the e-commerce platform has certain obligations. They have to basically ensure that the composition dealers or small dealers who are onboarded with them, they should be also compliant. I mean, they can't say that it is their responsibility and we are merely an aggregator. So they have introduced also a provision to say that if the composition dealer or the unregistered person does any gross violation of the GST law, then even the e-commerce platform could be held liable for penalty in case of such violations. So basically, the e-commerce platform will also be more vigilant, but at the same time, they will be more inclusive. They will allow composition dealers, small dealers to work along with them. The other important amendment which has come is for the exempted dealers. I mean, companies who are engaged in completely GST exempt transactions. For example, fruits, vegetables, those kind of products, wherein there is no GST applicable, but there was always an ambiguity on whether GST will apply. I mean, whether they have to take registration under reverse charge for transactions such as goods transport agency, legal services. So many companies had received notices also, or some companies had voluntarily they went ahead and took registrations, even though they were completely doing an exempt activity. But now they have clarified that if a company is only doing 100% GST exempted activity, then there is no requirement to take a registration for them. So again, a welcome move. The third amendment is for time limit. I mean, they have said that if you want to file a GST return, there are due dates for that. But earlier, there was no outer time limit for filing a return. I mean, of course, it will be a delayed GST return. But now they have said that after 3 years from the due date of filing the return, this will no more be considered as a, I mean, you will not be allowed to file a return. That's the point they are trying to make. And earlier there was no outer time limit, which they have introduced now. GST and portal, as you all know, most of the members and industry, everybody, they by now would have got onboarded for the e-invoicing regulations, wherein whatever invoices we raise, there is a requirement to upload or to send that information on a real-time basis on the government portal and generate a QR code and a IRN, which needs to be printed on your invoice. And this is right now applicable for companies having annual turnover of more than 5 crores. Earlier, they started with 500, reduced it to 100, then 50, and now it is 5 crores. So what they are trying to say is that the entire data, the GSTN has a lot of transaction level data of all the companies with them. And what they have said is that the GSTN portal will now be authorized to share content-based, consent-based information of the content with other notified systems. So this could include income tax, this could include other regulatory authorities. So the point to take from here is that we need to be careful and vigilant on the fact that the data that we transmit to GSTN portal and the data that we report in our other regulatory filings or tax filings, including income tax, should always be consistent. And if there are any differences, we should know the reasons and justifications. If they are valid, we should have that justification in place, because now government is sharing everything amongst themselves. So that is one point which all of us should be taking a note of and should be aware about. One welcome move is decriminalization under GST. So there have been many instances of, investigations, summons, search and seizure, raids by the GST authorities in the last 18 to 24 months, and more so in the last 1 year post the COVID. When everything opened after COVID, there have been instances where sometimes the assessee might have felt aggrieved that the authorities have gone slightly overboard or invoked prosecution provisions and all. Now they have said that there should be some regulations around that in terms of the limit. So earlier the limit for prosecution was 1 crore. Now it is increased to 2 crores. At the same time, they have said that there are certain defaults for which prosecution can never be initiated. One of them is obstructing or preventing any officer from doing his duties, tampering of material evidence. Sure, these are contraventions and there can be penalties for that, but prosecution cannot be invoked for this. So again, a welcome move. The last point is with respect to input tax credit denial. So on CSR activities, corporate social responsibility, and this topic has been up for debate since last 5 years since GST was introduced. And many companies, especially public or listed companies, have been incurring CSR related expenses, which is also an obligation for them under Section 135 of the Companies Act. And there was a debate that we should be eligible for GST credit of whatever expenses we are incurring because it is related to business, it is mandatory under a law. And in fact, there were some positive advance rulings also to support this view. And some of them were also contrary. I mean, there were advance rulings on both the sides. But now they have brought a specific provision in the law saying that on CSR expenses, you will not get credit. So this is a point to note. There are some finer aspects around this. I mean, what the language of the law says is that whatever is mandatory under the Companies Act, to that extent, you will not get credit. So the question arises is that if I'm incurring something over and above what is obligatory, something that I'm doing voluntarily, should I be eligible or not? That question is still unanswered because it's not mentioned in black and white. But the intention of the government appears to be that they don't want to give credit on CSR related expenses. Some customs duty related changes, which I will just take you through. And these are more so for the consumer products. I mean, there have been some rationalization, some changes in the customs rates. First, we'll look at products where the rates have increased. So if you notice some products like bicycles, toys, electrical kitchen chimney, I mean, for those products, and this also include EVs, and if you import an electrical vehicle from outside India, the customs duty rate has been increased for those products. And this again goes well with the Make in India initiative of the government. They want to promote the domestic industry. They want these products to be manufactured in India and not imported. That seems to be the intention. Also, the government has already announced that they will be launching PLI schemes for bicycles as well as for toys industry. So again, this amendment goes in line with what we are saying for I mean, the customs duty rate increase which is there. So they are basically promoting manufacturing in India and the domestic manufacturing sector. For some products, the customs duty rate has fallen down also. For example, seeds for manufacture of lab-grown diamonds. So for diamonds, what they say is that now time has come that naturally mined diamonds may not be able to sustain the demands of the market on a long-term basis. And that's why alternate measure was to develop this market for lab-grown diamonds, which have the same characteristic as a naturally grown diamond. And they want to promote this industry. And there is this manufacturing process which happens in India. So seeds which are imported for manufacture of lab-grown diamonds, for that, the customs duty rate has been reduced from 5 to 0. Similarly, parts for manufacture of TV panels, parts for manufacture of mobile phones, more specifically camera lens, for that the customs duty rate has gone down. So again, these changes are to encourage manufacturing in India. So they want Indian companies or even MNCs to set up plants in India to manufacture TVs, manufacture mobile phones, the diamond industry. So these all changes are consistent with this objective kept in mind. There are some exemptions. So the third amendment which has happened in customs is they want to simplify the customs rate structure. A lot of customs duty exemptions were there traditionally. And over a period of last few years, they have tried to reduce the number of exemptions and also rationalize the rates so that there is the disputes come down, the complications in the customs rate schedule come down. And in light of this idea, what they have done is that they have extended the exemption for some products, but for some products they are saying that the exemptions which were introduced, which they believe are no more required, they will not be extended beyond 31st of March. So these are some specified machinery, capital goods for manufacturing, sports goods, leatherware, fisheries, gems, jewelry, etc. Similarly, they have marginally increased the excise duties on cigarettes. Again, cigarette being a demerit product, there is an increase in the NCCD, what we call as National Calamity Cess, has been increased, because of which there may be a marginal increase in the price of cigarettes as well. So these were the key amendments with respect to indirect taxes which were announced in the budget. Now I will take you through the recent updates, the important ones in the last 3 to 4 months or so, which all of us should be aware about. So what are the recent trends which are there? I mean, when we look at the ground level practical realities, when it comes to assessments, what is the department doing? How are we filing returns, so on and so forth. So one is that the government clearly believes that they want to tighten the income tax, input tax credit related provisions here. And they want to ensure that the input tax credit provisions, I mean, there should not be any excess credit taken. The credit should be matched and ineligible credit cannot be taken. They want to keep a tight watch over that. One of them is the CSR amendment. They have also been issuing many notices for GST credit mismatch with vendors, and I'm sure most of you might have already received notices regularly asking for reasons for the mismatch. So they are keeping a very close watch on that. Second is GST audits. Departmental audits have increased to a great extent in the last 6 to 9 months, and they have started issuing notices. There are two reasons for this. The first is that the pre-GST law, which was VAT, service tax, I mean, excise and all, those, the disputes under those, I mean, first of all, those legislations are now subsumed, they are no more there. But also the litigations, they have introduced a lot of amnesty schemes, including states like Maharashtra, Karnataka, West Bengal, Kerala, Rajasthan, and the list goes on. They have been issuing amnesty schemes for companies to just close the old matters. So it means that the tax administration or the tax departmental officers now will be focusing more on GST audits, because they have the bandwidth now to focus on the next law, which is GST. And now we have finished almost more than 5 years of GST in India, and this is the time for the department to step up on the accelerator and try to intensify their efforts on GST audits. So that is the trend that we are seeing. Expansion of e-invoicing network, and this was one of the questions which also we saw, which was raised by one of the members, that what are the changes with respect to e-invoicing. On e-invoicing, yes, the government's intention is very clear. They want to cover everyone in the e-invoicing network. Basically, e-invoicing means that whenever you raise an invoice, you have to upload that invoice details on the government portal, and then immediately you will get a QR code, and only then your invoice becomes a valid invoice. Otherwise, it is treated as an invalid invoice for GST purpose. So right now the limit is 5 crores, but they want to make it to 0. So in the coming months, coming years, they will make more and more announcements. So it's a matter of time that everybody eventually will get covered under e-invoicing. And this has given rich dividends to the government also. The tax base has increased. The number of assessees have also increased. and the collection has also increased. So if you see, if you have read the recent news articles and the statistics that come with respect to the GST collections, the GST collections are now consistently clocking more than 1,50,000 crore per month. And if we compare that with 2017, 18, 19, they were less than 1 lakh crore. So you can see a huge increase. It is almost 70 to 80% increase in the GST collections. And this is because of increase in the e-invoicing network, measures like e-way bill. More and more dealers are now coming in the tax net. It's not that they have increased the GST rates. If you see, the GST rates which were there in 2017 are pretty much the same. In fact, they have reduced the rates for some of the products from 28 to 18, and they have rationalized some rates. But really, the collection is coming through these measures where they are increasing the tax base. Digital tax administration, of course, we discussed about the GSTN portal, which has the live data. Pruning of exemptions, they don't want to give too many exemptions so that the complications reduce, litigations reduce. GST stakeholders include finance, supply chain, operations beyond tax. So the message is that GST subject may not be only limited to the tax office. It will also always have finance, supply chain. They will also have an impact because of the GST amendments and legislations. Some future expectations. State compensation, cess, and consequent impact. So state compensation and which is currently given by central government, that eventually they will try to reduce, they will try to move away from that. Continued reviews of potential tax leakages, fraud cases. So that will continue. They will try to tighten the screws. They will try to catch hold of fraud cases or identify cases where there is a evasion of tax. Those things, those measures or those activities are expected to continue and even intensify. Strengthening the advance ruling and appellate mechanism. So this is one area to work upon. We will be having, right now we have an advance ruling mechanism, but it is state-wise. They want to, there is a thought that it should be at a centralized level and it should be more empowered so that we get more realistic or more assertive judgments on advance ruling and more reasoned judgments. So that is one. Also, the GST tribunal has still now not been in force. We are in the 6th year of GST, but still you don't have a GST tribunal. That is also an expectation. In fact, the next GST Council meeting, which is on 18th of February, one of the agenda points expected in that meeting could be to discuss the way forward for setting up a GST tribunal. Input tax credit availment conditions. So basically they are now saying, so this is an important point for us to note, that when it comes to input tax credit mechanism, they are saying that for the period up to December 2021, the conditions under law were that if your vendor has paid the tax, GST, then you should be eligible for input tax credit. Now, from Jan 2021, they have introduced the provision which says that even if your vendor has paid the tax, but let's say he has not reported that on the government portal, which we popularly called as GSTR 2A, if it is not reflected, then you will not get input tax credit. So from Jan 2022, the position is absolutely clear that your vendor has to upload on GSTR 2A, the government portal. But for the period prior to Jan 22, that is up to December 2021, you can look at options like obtaining confirmation from your vendor that they have paid the tax. You can, in fact, there is a CBIC circular also where they have said that you can get CA certificates from the vendors certifying that your vendor has paid the tax. If that is done, then your input tax credit will not be questioned, even if it is not appearing in GSTR 2A. So what they are saying is that going forward, uploading on government portal is mandatory. Invoice to invoice reconciliation is an essential requirement for everyone. And there are solutions available. You should make maximum use of technology here. Try to automate our accounts payable process so that vendor payments are automated. We pay vendors, we ensure that vendors are giving us the right kind of invoice. We also keep a watch on our vendors that if we are paying them, then they are also paying the GST to the government in time. And suppose the vendor is not paying GST regularly, is there a possibility that we withhold their payments, keep their payments on hold till the time they pay? Because otherwise, as a buyer, as a recipient, we will suffer if our vendor doesn't comply. So there is a need to automate our AP processes. Some changes, procedural changes with respect to input tax credit, which we already discussed on the CA certificate for and getting vendor declaration and all. Apart from that, some other procedural changes which are there, which is if your GSTR 1 and 3B return is not matching. So you every month all of you must be filing GSTR 1 by 11th and GSTR 3B by 20th of the month. And if the amounts in both the returns are not matching, you will get an automatic notice from the government or an intimation that it is not matching and you have to give a reason. And if you are not able to give a valid reason, then you will be required to pay the differential tax. And if there is a regular default, they may even suspend or cancel the GST registration. So they are monitoring it very, very closely on a monthly basis. So this is a point to note. PAN link, mobile number, email address. So they want to link it everything to PAN, OTP based verification for the registration process. This is again try to an attempt to remove human intervention. It should be completely automated and system driven, the entire registration process. Time limit to raise credit notes has been extended up to 30th November. So these are certain procedural changes. Couple of rate changes which were announced, which I would like to take are just I'll mention it briefly. One is carbonated beverages with fruit juices, which are essentially all these fruit juices which contain a fizz or a carbon dioxide. For that, earlier there was a dispute on what is the GST rate, whether it is 12% or 40%, because aerated drinks like soft drinks, which we buy in the market, are all under 40%. But fruit juices only without carbon dioxide is 12, and fruit juices with carbon dioxide, there was a dispute. Now they have issued a circular that will also be 40%. So this is an important point to note. Also, snack pellets such as Fryams, they have issued a circular that it is at 18% GST. These are some of the typical issues that the government picks up at the time of GST audits. So if not now, in the coming few months, you will be receiving notices from GST department to conduct GST audits. And we should be aware what kind of issues they are picking up, what kind of points they are picking up. So reconciliation, safeguarding state revenue, verification of tax provision, ISD mechanism, cross-check. These are some lists. I mean, it is not an exhaustive list, but this is only to give you an idea on what kind of preparation we need to do. Some key judgments, some important judgments which we should be aware about. So here what they are saying is Supreme Court held that the dismissal of a writ petition. So basically they are saying that if we go for a writ petition on any issue, generally the High Court may say you have an alternate remedy, you cannot come to me. But now the Supreme Court has said that even if there is an alternate remedy, the High Court is required to at least hear the matter. They cannot just dismiss the matter merely on the ground that there is an alternate remedy. So an opportunity of hearing should at least be given. So it's a good judgment. GST anti-evasion wing or range officer. So if there are two different authorities, two different departments who are issuing the same notice and doing audits again and again, there is a judgment which says that if one authority has already done the audit, then other authority cannot initiate the same proceedings for the same period. So again, a good judgment to quote. Court has said that there will be no separate levy of IGST. So this is on ocean freight, very famous judgment which came in, wherein they say that no IGST should apply on ocean freight in case of import of goods for CIF contracts. Very talked about judgment was on secondment, which is in the case of Northern Operating Systems. wherein they have said that if there is a deputation from foreign company to Indian company, there will be service tax applicable under reverse charge. And this is although it is a service tax decision, it will equally apply to GST also. So very important decision. It will have an impact on, it has an impact on multiple industries, and many companies have already received notices on this. Many companies are preparing a strategy going forward how to handle this. Some provisions with respect to, or judgments with respect to anti-profiteering, where they say that in one case they have said that if the main manufacturer has been already investigated for anti-profiteering, then the dealer cannot be again investigated because the main brand owner has already got the order for anti-profiteering. So the dealers, retailers who are dealing with the brand owners, for them this could be a relevant judgment. Then they have said that condition on the supplier to pass the benefit of reduction in taxes. The benefit cannot be passed by giving extra grammage. So many companies have tried to do that. That when GST rate falls down, instead of reducing the price, they have just increased the grammage of the product. A product which was, let's say, 100 grams, now they are giving 110 grams for the same price. But that is not considered as compliance with anti-profiteering. We have to necessarily reduce the MRP. That's the intention of this anti-profiteering provision. Some other judgments, High Court held that they cannot just, cancellation of registration and all cannot be done without issuing a show cause notice. A show cause notice has to be given, opportunity of hearing has to be given. Again, an important judgment which will help us in our day-to-day operations. Order issued without granting opportunity of being heard cannot be considered as a valid order. Again, very important. Department cannot issue summary of SCN without issuing proper SCN on the tax payer. So this is also similar to point number 7. Both the judgments go in the same direction. So these were some of the important judgments which we thought are relevant for the entire industry and for all the members. We hope this discussion and this update was useful to all of you. We can take some questions now. I mean, we have a list of some questions. Palak, should I read out the questions and take them? Hello?
Hello?
Yeah, so one of the questions which we thought is relevant, I hope I'm audible right now. One of the questions which we thought is relevant, which was asked by the members, is with respect to the e-invoicing related changes, which I tried to take during my session, wherein we are saying that the e-invoicing regulations are becoming more and more strict, and the turnover limit is getting reduced. Nothing has happened in this budget, but over a period of time, they have gradually reduced the turnover for e-invoicing compliance, and more companies are getting covered in the net of or the bracket of e-invoicing mandatory regulations. So that was one question. I will just see the other ones which are there. Rahul, would you have the, I'll just read out one or two questions, the questions for direct tax. One was with respect to budget impact on e-commerce business. Yes, we discussed the budget impact on e-commerce business, wherein they are now allowing e-commerce traders to onboard composition dealers also. And at the same time, e-commerce operators are also responsible for the compliance or overall, if the unregistered dealers or composition dealers do any non-compliance or contravention, e-commerce operator is also liable for penalty. So that is on the e-commerce operator impact. With respect to, I think there was one question with respect to direct taxes on HRA. I'll just try to read it out. Given the rapid urbanization that India has been expecting over the last decade or so, isn't it time to redefine the definition of metros and non-metros for the purpose of calculating HRA exemption? Secondly, I would like to know what has been the practical and on the ground use of professional tax, given that this amount is very small, and which is considered as a deduction for income tax.
So
Yeah,
I think I think I'll take the first one first. I think it's a valid point given the cost of living. Government should consider bringing in a mechanism to compute HRA separately for metros, non-metros. That will surely be a welcome relief. But having said that, one of the things which the government wants to do any which ways is to do away with the exemptions and deductions. And be it corporate tax or individuals, they are wanting to move to a regime and keep compliances and taxes simple by removing exemptions and deductions as well. So while point taken in terms of it would be, a lot of relief can be sought by, through HRs, I think, but the intention of the government is always to move towards a regime without minimalistic exemptions and deductions.
Perfect. Thanks, Rahul. There were a couple of questions on GST, one was with respect to input tax credit details to be mentioned in GSTR 3B return. Yes, there have been some changes in the way you report input tax credit in the GSTR 3B return, wherein you have to show the gross credit, then you have to reduce the reversals of input tax credit or ineligible credit and show the net. And this is a pain point for the industry because most companies were not even recording the ineligible credits. They were just charging it to P&L account as a total cost because you don't get input tax credit on some expenses like rent-a-cab, catering, food-related expenses. But now this is an added compliance for companies to report this. So this is an impact because of this. We also discussed about new amendments in GST. I think that was also one of the questions. Specific impact on jewelry space. We discussed about lab-grown diamonds, which is one impact on the jewelry space. Also, there have been some changes on import of silver bars and doors and articles of, imitation jewelry, as well as some articles of, precious metals, precious articles. On that, the customs duty rate has increased. So that is the other impact. It is not impacting the domestic manufacture if you import this. So these were some of the questions which were asked by the audiences. Very interesting questions, very relevant, and we have tried to address these questions. Yeah, so I think that was it from our side. Palak, if you would like to add any closing remarks before we conclude.
Yeah, one question which came up was regarding any pre-ONDC pathways being created on tax reporting for independent retailers.
Yeah. Rahul, you would like to add anything on this point?
So, Palak, do you want to repeat that question?
Yeah, it's regarding the ONDC, wherein any pre-ONDC pathways that are being created on the tax reporting for independent retailers. I've typed it in the chat box also.
We haven't heard much in terms of any tax reporting for independent retailers is pertaining to ONDC pathways, but we can check and come back to the group on that. Not that I've heard anything on the budget that has come specifically on this.
Not a problem. Thank you, EY team. I think it was a wonderful session, and most of the questions, most of the queries were somehow resolved by you, and it was a very comprehensive learning from the experienced professionals. Thank you, everyone.
Thank you very much.
Thank you.